Welcome back, everybody, for my portfolio update for March 2024. And for the past 2 months, I've made multiple changes to move out of slower growing companies and ETFs like Walmart, Hershey, and SCHD, and added companies that I think have better long-term growth prospects, such as Amazon, Google, MSCI, and now, if you've been watching my videos this month, you already know, NVIDIA. And of course, that has raised some questions from some of you all out there about not understanding what I'm doing or why. And that's totally fair. It comes with the territory of sharing your portfolio online, sharing all your buys and sells, because not everyone's going to agree with what you're doing or what your approach is. So we're going to dig into it a little bit in this month's video. Now, the market in March continued its run with the S&P 500 being up almost 4% and over 10% year to date. But some of my largest holdings had one of their worst months in a while. So how did I actually end up? And what I think you'll see is a continuation of some of the trends we talked about last month as I slowly adjust my portfolio for what I think is going to be better long-term returns. But first, let's get into some of the details. Now, as of March 31st, my account is currently at $273,778.03. And in this last 1 month, my portfolio balance is up over $8,800. So let's dig into the details. And if we adjust this to see how we did for March only, we see that my beginning value was $265,375 and some change. I made $1,200 in net contributions, and in terms of my overall investment change, it was $7,202.57, which was mostly investment gains of $6,439, as well as $762.65 of dividend income and account interest. Now, in terms of overall gains, being up $7,000 or about 2.7% of my total portfolio in 1 month is pretty good, but let's see how we did against the S&P 500. And so as you can see for the month, the S&P 500 was up 3.22%, accounting for the timing of my contributions, and my portfolio was up 2.7%. So we trailed the index by just over 0.5% in March. And if we take a quick look at the year-to-date performance for 2024, the S&P 500 is up over 10% at 10.56, and my portfolio is at 6.54%. And now, just for consistency, let's take a look at the performance of my portfolio since I started it on December 8th, 2022. And we see that my portfolio is up 18.24% compared to the S&P 500's 26.72%. But wait a minute, now that we've actually passed over a year of having this portfolio, I got to tweak this a bit to show you the total return. Because by default, it shows the annualized returns, which show you the equivalent basically per year return based on the total return. And now if I turn that off, it shows you the total return since I started, and it looks a little bit worse, with my portfolio returning 24.58% since I started, and the S&P 500 returning 36.42%. So since inception, I'm trailing the S&P 500 by a little under 12%, and there's a couple different ways you can look at that. First off, you could say, hey, that's pretty bad and you should just buy the index. Okay, that's fair, but we are only 14 months in. And that's a lot of why my own assessment of my portfolio at the end of last year has driven the changes that I've made so far in 2024. And now, if we take a look at my investment income, specifically for the next 12 months, we see that my annual dividends and interest are at $3,528.56, compared to the $3,990.80 that I had last month, which is a decrease of $462.24. This is the second month in a row that it's gone down instead of up. But again, it's based on the changes and the repositioning that I've been doing in my portfolio, so it's kind of expected. Now, overall, my dividend yield for my portfolio has now dropped to 1.3%, and normally I like to see it more around 1.5 or maybe 2%, but at the end of the day, it's not really about current yield, it's more about total return and then obviously dividend growth. Let's actually take a look at what dividends hit my account for the month. On March 1st, I received $72.40 from Visa in 3 different accounts. On March 4th, I received $214 from Valero in 3 different accounts. And then on March 15th, I received $208.75 from McDonald's in 3 different accounts. On March 19th, I received $94 from United Health, and then on March 25th, I received $183.30 from SCHD, which is Schwab's U.S. Dividend Equity ETF. I had a total of $762.45 in dividend income for the month, and March tends to be when most of my dividend payers hit, so it was a pretty nice month. But let's take a look at what I actually bought and sold for the month of March. On March 5th, I bought 6 shares of Apple at $170.92 a share. On March 20th, I sold 50 shares of Valero at $167.55 a share. And I also sold 125 shares of SCHD at $78.46 a share. And then also on March 20th, I bought 20 shares of Nvidia at $897.85 a share. On March 26th, I bought 10 shares of Starbucks at $90.88 a share. And then on March 28th, I bought another 5 shares of Starbucks at $91.59 a share. In terms of trimming Valero, it was simply about this. I like Valero as a company, but there are real questions about their long-term growth because they're in the oil and gas industry. Plus, their projected growth as of right now is actually negative. So since it ran up so much from the time I started buying it, I decided to lock in some profits and put that into other opportunities. And as you'll see here in a second, I still have quite a bit in my portfolio because I kept about 75% of my shares. But Valero might be one where it's so volatile that I actually may just add and trim as it goes up and down. Now, in terms of trimming SCHD again, I talked about this in my recent SCHD video, but it's about control. I want to pick the majority of stocks in my portfolio to try to beat the market. And SCHD's methodology is mostly focused on high quality dividend yield, and that's just not my portfolio's focus. So I still kept a small allocation to it, but it was a logical place to trim for my specific situation. And that's where I think some of the questions of what am I actually doing are coming from. Because some people are assuming that I'm not thinking long term with these decisions because I'm selling out of value positions that are down and buying into more growth oriented positions that look overvalued. But then from my view, I actually think I'm doing the opposite because the changes I've made have a more long term focus. And let me explain what I mean. In 5 years, if I do nothing else, do I think a combination of Walmart, Hershey, and SCHD is going to outperform a combination of Amazon, Nvidia, and Google? The answer is no, I don't. And that's not to say that Walmart, Hershey, and SCHD aren't quality companies or a quality ETF. And depending on what your strategy is for your portfolio, they actually may be a better fit for you than Amazon, Nvidia, or Google are. But for my particular strategy, they're not. So while on the surface it may look like a FOMO trade, it's actually the opposite. I'm trying to get a basket of companies that I think have a chance to outperform for years to come, and not just something that was down 30% over the past year, but has questions about long-term growth. But like I always say, these are the type of things that make investing interesting. Like we don't always have to have the same opinion, and we can put our money towards the ideas and the companies that we think fit best for what we're trying to do. And so in my opinion, the changes I've made really are more future focused and actually give me a chance to try to hit my portfolio goal. And so with that in mind, let's actually take a look at my updated portfolio allocation weightings. McDonald's is still in the top spot at a little under 13%. Visa is next at 12.23%. Amazon is new at number 3 at 10.15%. Apple is 4th at 9.77%. Valero, after trimming, is now 5th at 9.35%. United Health Group is at 9.04%. American Express has kept on rising and is now over 8.32%. Nvidia is new to the portfolio and it's at 6.6%. Google's at over 5%, and Caterpillar keeps crushing it and is now over 5% as well. Starbucks is at 3.84%, and MSCI is at under 2%. Oh, and I always forget to show SCHD because it's at the bottom here, but it's now 5.15% of my portfolio after trimming. And so now if we take a look at which holdings have performed the best overall, and remember, this is just price return since I take my dividends in cash to reinvest them manually. American Express just keeps going up and is at over 49% gain. Caterpillar is another one that just won't stop going up, over 48% now, and Valero is at just over 45%. So those three have just been absolutely crushing it. And then after that, there's a big drop-off in total performance. Amazon and Visa are both up over 14%. Now, if we go down to SCHD, we see that it's actually up over 10%. And now back up to United Health Group is up almost 8%, but that's been a holding that has really struggled lately, down over 6% year to date. Now Google's up over 6.5% as a relatively new holding, and McDonald's is up over 4.5%, but this is my longest holding in this portfolio. So in general terms, it hasn't performed all that well, and it just so happens to be my largest holding. And we haven't talked about McDonald's in a while in terms of their overall business, and as my biggest holding, they definitely impact the overall performance. So I'm going to work on a video that talks about what I think of the business and what I see for them going forward. Now, Nvidia is new to the portfolio, and even though it shot up in that first week or so that I bought it, it's back down to a little less than 1% gain. And then for my 3 negative holdings, there's Starbucks, which is down over 2% and really hasn't done much since I bought it in August of last year, but I actually just added to it this past month. MSCI is down 2.78%, but that's a relatively new holding. And then, of course, there's Apple, which is my worst performing holding at negative 8%. Now, if we take a look at just the last month, you can see that as of March 31st, Valero has been on fire at over 22% gain in the month of March. And I did end up trimming about 25% of my Valero holding because it's gone up so much, which I talked about earlier. Now, Nvidia is up over 16%, but I bought in later in the month, so I didn't see most of those gains. Caterpillar is still going strong at over 11% in the last month, and the cat run has just been crazy. I don't know what else to say about it other than that. Google had a great month, up over 10%, and American Express has been on a crazy run too, and slowed down a bit, but still a very good 4.43% gain in March. Amazon was up over 4% as well, and SCHD was actually up over 4% in March as well. Now, for my 6 negative holdings for the month, United Health Group was slightly negative for March, MSCI and Starbucks were down over 1%, Visa finally cooled off after its nice run and was down over 2%. McDonald's was down about 4.5% this month, and Apple continued down almost 5.5% in March. So if you take the fact that my 3 largest holdings at the beginning of the month, which were McDonald's, Visa, and Apple, were also my 3 worst performers for the month, the fact that I trailed the S&P 500 by only about 0.5% is actually pretty good, all things considered. Okay, so as promised, let's take a look at my top 4 for 2024 stocks and see how they've been performing. Valero and Caterpillar have absolutely crushed the S&P 500 so far this year. Now, Visa was outperforming, but after this month is now trailing the S&P by just under 3%. And then Hershey has rebounded a little bit, but still trailing the market by a decent amount. But again, I sold out of my position in Hershey on February 12th of this year. And if we look at the performance versus the S&P 500 before and after that, we see that before it was pretty close to the S&P 500, but since it's underperformed by quite a bit. And again, that doesn't mean that Hershey's not going to rebound from here. It's just I want to show the impacts of my decisions in the most transparent way that I can. So let's take a look ahead to next month and what holdings I think I'm going to add to going forward. Now, in terms of ones I'd like to see a little bit higher in terms of allocation, I'd actually like to see Amazon and Nvidia be higher. Now, Amazon's already over 10% and Nvidia's at 6.6%. But they are the 2 companies that right now I have the highest conviction about in terms of their ongoing growth. I'd also like MSCI to be higher than just 1.84%, just because that's pretty low. But I've pretty much given up on adding Caterpillar anytime soon, but at least the fact that it keeps going up is increasing its weight in my portfolio anyway. In terms of ones I think are the best value right now, believe it or not, I would say Amazon, Apple, and Starbucks. And I know some people will laugh about Amazon being on that list, but if you saw my video about when I added it to my portfolio, the way that I'm valuing it is slightly different than just using the traditional methods. And let's not forget that since February 7th, Jeff Bezos has sold 50 million shares of Amazon, and the stock has still slightly outpaced the S&P 500. So yeah, I feel really good about Amazon going forward. Other than that, in general, I plan to focus more on my existing companies over the next couple months, but I will be looking for a mid-cap opportunity to add to my portfolio at some point this year, which I talked about a little bit in my newsletter this past week. So in terms of exactly what to expect over the next month, this is what I anticipate. I'll be focusing on adding more to high conviction holdings, I'll be researching mid-cap opportunities, and I'll be preparing for the ups and downs of earnings season. So while not everyone's going to agree with my decisions or the amount of activity that I've had in my portfolio lately, it's still all in the spirit of trying to reach my own personal goals, which we like to talk about every month. And it's to beat the S&P 500 in total return while creating a growing passive income stream for my family. Now, my strategy to achieve it is I want to attach myself to companies with wide moats that are generating increasing cash flow and rewarding shareholders with dividend growth that outpaces inflation. Now, one question that I get sometimes is, if dividend growth is important to you, why are you cutting your dividend payers and buying companies that don't actually pay dividends? And I think that's a totally fair question. In reality, I should probably tweak the wording of my strategy because I do want dividend growth that outpaces inflation, but companies that do a large amount of share buybacks are also giving capital back to shareholders in the form of an increased percentage of ownership in the business's future cash flows. And so to me, that's just a slightly different approach to the same idea. It's a company that is generating a lot of cash, and they're rewarding shareholders either by giving them dividends that increase higher than the rate of inflation or by doing share buybacks that increase my percentage ownership in the actual company. And being that I'm still 10 to 15 years away from retirement, focusing on actual dividends right now isn't the most critical thing to me. So as long as the company is rewarding shareholders one way or another, I'm actually good with that. Hopefully that makes sense. And what I'll probably do is tweak this on my strategy slide so that it adds that distinction so that it'll be more clear for next month and going forward. So if I recap what happened this month, my portfolio went up a decent amount but lagged the S&P 500 by 0.5%. Annual dividends decreased for the second month in a row, but it was again by design. And the remaining 3 of my top 4 picks for 2024 are still performing strong, with 2 picks crushing the S&P right now, and the third, Visa, trailing but still performing well. And overall, the performance of my portfolio has actually been pretty decent. Like, we focus a lot on the fact that I'm trailing the S&P 500, but if we just take a look at what's happened in absolute terms, when I first shared this portfolio in August of last year, it was at about $227,000. And since then, it's gained about $46,000, which is broken down into about $12,000 in additional money added by me and about $34,000 in investment gains and dividends. So that $34,000 is about a 15% total return over the past 7 months. Now, obviously, if I had just put it in the S&P 500 over those 7 months, then I would have had a better return, but it's still a pretty respectable return. And you guys have been able to see all my buys and sells and my progress along the way. And so I'm pretty proud of that. And to me, we're just getting started. Plus, with the changes that I've made, I think I have a much better chance to make up some of that ground on the S&P. But of course, only time will tell. So how did you guys end up for March? The market seems to just be going up like there's no problems in the world, so hopefully your portfolio went up as well. Now, if you want to see why I actually added NVIDIA to my portfolio at these levels, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.